Good morning, everybody. Welcome to another edition of All In Metals. I just wanted to go through kind of a personal recession indicator that I've kind of used over different periods of time. Again, not foolproof, but something that I wanted to bring to your attention to see if you're experiencing some of the same things I have been over these recent weeks and months. Of course, this is a big economic indicator week. We got two big pieces of data coming out. Of course, the Fed meeting on Wednesday, and then, of course, first read of the second quarter GDP on Thursday. And so this is going to be a very interesting and probably volatile week, I would suspect, as potentially we go into technical recession based on the definition of two negative GDP quarters, if that should come to pass. So, and I'll show you some slides here in a second as well on just where we're at on that, which certainly is indicating that we're heading that way. But the purpose of this video, I think, was to kind of highlight some things that I've experienced. And I want to see if you have all experienced something similar or regularly. So imagine, you're in the drive-through, pick any restaurant. I'm going to use Chick-fil-A here as an example. And again, any of these names I throw out is not to disparage any. I love all these places. I love to eat out. We love to eat out as a family. So it's just a matter of this is just what's happening out there. In my opinion, workers are seemingly not caring as much as they should or have in the past. Maybe aren't trained or are too new or aren't being retained. So again, for those that might have companies out there or small business, again, the importance of longevity, having the right people, retaining them, and having them know and care about your business is pretty key. So you're in this, drive-through, as many of us do take out and carry out these days. And so I get to the window and Chick-fil-A, and they read back my order. You had this, this, and this, and it sounds good to me. I say, yes, that's what I ordered. And they hand me a bag. So I proceed out of the line, head around the corner, stop at the stoplight. And as I'm glancing over at the bag, I see on the sticker some items on there that I don't remember ordering, one being some hash browns. So I'm like, wait, this doesn't make sense. So I circle back. Lo and behold, I have received the entire wrong bag and wrong order. That's one quick example. Olive Garden, order takeout, even asked at the counter when I placed the order, waited in restaurant. Yeah, these come with breadsticks, right? Oh, yeah, most certainly. So, I get my bag, get home, lo and behold, no breadsticks. Texas Roadhouse takeout, ordered 4 meals. One whole meal was not in our order. Panera, Wendy's, KFC, sides not making it in the order, etc. We ordered some dishes recently. I'd say half or so of those dishes arrived broken. These are cups, mugs, plates, that sort of thing. So my point here is this historically has happened, I think, along the lines and time frame of the Great Recession. I noticed the same trend happening. I don't know if it's full employment or what, if we're even at such with the participation rate, etc. It's hard to know exactly where we're at in employment. Obviously, the unemployment numbers are historical lows. So one would say that we're at full employment and there's more jobs than there are workers. But at the same time, it doesn't mean that we're not heading toward recession. This is just my recession indicator. When I start noticing this tick up on a very regular basis, that I usually get a little concerned that the market is about ready to turn, and we may as well see that this week. So we'll see about that. Another thing too is Gen Z workers may not be entering the workforce, kind of like younger folks in the past have traditionally gone out to get summer jobs, etc. So there's kind of a scramble for those looking to enter and do a good job and care about their jobs, etc. So obviously we're moving into a period, a rate cycle of hiking rates into massive and growing debt national corporate and national debt, corporate debt, and most importantly, personal debt. So rates going higher at a unprecedented high inflation over 40 years. So we have this unending debt creation cycle from the Fed and bond buying by central banks, who are continuing to step in and buy over this period. And what I would say is managing the curve. They haven't come out and said that, the Fed or central banks, but in essence, isn't that what is happening? Or what if that is happening? And all these are inflationary. So where do we go from here when these things are happening? So I say buckle up this week. This is going to be a very interesting week. It'll try to be smoothed and managed, I'm sure, by the rhetoric and the talk of the Fed and the Fed Chair Powell. And of course, they're going to make their decision, render their decision of probably a 0.75% or a 1% rate hike on Wednesday. Of course, that'll come before the GDP announcement, which will be very interesting. So I'm curious to see how that plays out this week, as you all may be as well. So, and again, still a lot of talking heads out there speculating that, maybe we have a slightly positive GDP read. So that could happen as well. And of course, the whole point of that is maybe that's construed to be that, I don't know, to reset the clock, so to speak, to kind of manage the recession down into the first part of 2023. So we'll see what actually transpires here before our eyes, and what we can see in the mainstream, and what the indicators are actually given to us to be. Of course, by the Atlanta Fed's GDP Now read, where they're estimating where GDP will be, they are firmly showing a roughly negative 1.6 read at the present. This has been all through July, been in the -1 to -2% range, which would certainly indicate that as we get through to Thursday, that this would show up as a negative read. So that'll be very, very interesting to see if this is accurate in any way. And their next update to this, interestingly, will be on Wednesday, the date of the Fed meeting. So that's very interesting as well. So, the countdown to the Fed, this is the Fed Watch. We can see on any given meeting date, where the probability of the increase would be. And right now, the 0.75 point increase is 80% chance, with another 20% stacked on that for the 1% increase, bringing the target range to 250 to 275. Now, keep in mind, July and September here, these next two meetings, this quarter, third quarter, I kind of call this the freebie range, because they're not even attaining or getting to be attaining their neutral rate. So they have this extra runway, if you will, to go ahead and increase rates while just really getting to their, or just above their neutral rate, or what their dot plot forecast is. So interestingly enough, they can do 75s or 1s over the next two meetings, but it's really what's going to happen after that. And as you know and hear many out there, even the Fed itself and the futures market for Fed funds futures is actually forecasting a downturn mid-2023, meaning that the Fed is going to turn around at some point, because probably due to recession and souring market conditions, to say, well, we need to maybe start loosening monetary policy again. So that'll be interesting over the next 6 to 12 months. But anyway, as you all know, we got a big week coming up. So we'll see where all this transpires. The 10-year Treasury, again, this is where I was talking about managing the curve. The 10-year Treasury has dipped significantly over a 2-day period, from about 303 Might have been intraday at 306. I can't remember, but it's dropped 0.25% in just a couple days late last week. So we also know, and I firmly believe, that this was a period here where the the Treasury rate was actually starting to get out of control, hit upwards of 350 as did the rest of the curve, some topping 350, but then was quickly reeled back down, I believe, by the Fed intervention, and of course the ECB coming out with its unlimited bond buying package, if you will. So the big story again is inversion, yield curve inversion. As we see in the lower chart, I mean, it's pretty obvious to see that this curve is inverted. We got roughly 3% or 2.99 on the 2-year versus a 2.76 on the 10-year. So we've seen 20 to 25 basis points inversion over the last week or so, which again is usually indicative of recession. So very interesting times. So again, I would say, as these things unfold, the Fed is going to try for what they call a soft landing, probably unattainable. They're just going to try to manage everything as best they can to control the markets as they do. Stocks tried to rally up a little bit, ended lower on Friday, but overall up on the week. So again, kind of as Treasury rates fall further lower, again creates that TINA effect. There is no alternative. Again, trying to boost stocks higher, because generally 401ks and retirement accounts, generally people feel better when those are doing better. And of course, this management of all that over the short run may be attainable, but at some point, as we know, this 15-year period of quantitative easing and money printing and overall debt ballooning, it can't go on forever. So with that, I will leave you, and just some food for thought. And again, maybe you have some experiences like I mentioned on my kind of recession indicator, just a poor service environment. Doesn't happen all the time. Many times you get great service from these. But when I start seeing it kind of en masse, on a greater scales across different organizations and environments and retailers, etc., that again makes me believe that we're about ready to turn the corner. So, all right, everybody, have a great day. Take care.